Hey everyone, this is Ryan Mallory for SharePlanner.com. Today is February 15th, 2013. Doing another session of LiveCharts for you here. We got some market weakness that we've seen early on. I wouldn't say it was groundbreaking weakness, but considering the range that we've been trading in for about the last week and a half, I would definitely say that it's more than usual. Go ahead, just let's pull up the 5 minute chart here. If I can pull it up, there we go. And you can see that if we're just simply drawing a trend line off of the day's action, we had a nice series of lower lows and lower highs, but now we're getting this market pop again. These dip buyers that jump in almost regularly every day when the market goes down so many points. Typically it's like 2 or 3 points, and then you see the machines start kicking in and pushing this market higher. But like I said in one of my previous posts today, that the dip buying doesn't seem to be pushing us to groundbreaking highs or anything like that. The dip buying seems to be more out of like a damage control, keeping the market propped up, keeping it, at least at the status quo. That's a little bit concerning too, and something that when evaluating this market, keeping that in the back of your mind, that when we're seeing the dip buying, it's not like in the traditional past where we have a down day of like negative 3 or 4 points, and then all of a sudden we're up 10 or 11 points at the end of the day. More so, it's like we're down 2 or 3 points and we're going back up to like break even to maybe like a couple of points at best higher. And so there's just not a lot of, there's enough buying power to get us to break even, but not to really surge higher. So on the 5 minute here, just as we're rising, be cognizant of this downward trend line. There could be some, it's about a half point away. There could be some resistance that kicks in on that particular resistance level, but if we break through it, then you know that, okay, we're probably going to rally higher, and I would look at the next mark to be, because, well, at this point you would have already put in a higher high, which is what we're basically on the verge of doing as we speak. But then you want to see if we can get back above this 1523 level, which is only 2.5 points away. On the daily part of this chart, though, you can see we're continuing to toe the line on this 10-day moving average. Only one day have we closed below it. The rest of the time we've been trading perfectly above it. We tested it to a T yesterday, and that seems to be where a lot of the program buying continues to come in at, and we're holding the 10-day moving average, and until then I don't see there's any reason to even look at a short position right now. 1495 is where the bulls or bears, the bulls need to defend, the bears need to get price back below 1495. That's about 25 points away. So a good move comparatively speaking to what we've seen so far this year, where we only had one day where we were 1% lower, and it was barely 1%. So it's going to take a lot for the bears to be able to push the price back below that level. But if we can, I would say that would be a reason to get bearish in this market, and then look for a push back down into this rising channel line that, around 1465 to 1475 would likely be the area where it would find its initial support level at. Let's go ahead and look at some of your charts here. TSCO. This one's breaking out very nicely. 104.05 would have been the ideal entry to get long at. It's at 104.94 right now. Some of you might want to trade this stock at a break of 104.83, which is acceptable as well. I do like this chart setup. Let me show you exactly what I'm looking at on this. So for some, trading it that 104.83 level is the ideal entry. For me, if I was trading it, I would probably try to get in closer to this 104 level. It's not bad to wait till the 104.83, but just by getting in a little bit earlier than that, you're getting in as it breaks above most of the range of consolidation, and you can keep the stop loss at like 102.11. Either way, I think it's fine. There's just two different options depending on what your personality is as a trader, and how you want to approach it. So those are the two ones. I think the stop loss is the same. You probably want to go ahead and just trail this 10-day moving average, and if it dips below that, that's a good reason to dip out. But initially, Well, before you start using the 10-day moving average to trail your stop loss, wait for you to have wait to have about 1 to 2% in gains at least before you do that. Otherwise, I'd keep the stop loss maybe at like 102.11. You can maybe go a little bit below that down to 101.91 and keep the stop loss around 3%. Good looking setup though. I do like it. In fact, I will add that to my own watch list just so I can watch it as well. MENT. This used to be a favorite, last year trading this one because it has done pretty good. It might have been last year or the year before. At some point, I traded this quite a few times, and usually when it sets up very nicely and gives you a good opportunity. Just another stellar setup here that that was submitted. Ideal entry is probably 1740, 1742, which is where it's currently trading at. I do like this setup a lot. I'm gonna add it to my own watch list again. Here's the thing: I'm long 5 stocks right now, and I'm a little bit tentative about wanting to add more to the portfolio unless this market just makes a really good move higher today. Even then, I might be a little bit not cautious about it, just seeing what we do over a 3-day weekend. And but MENT, another. I mean, you like to think you wish you could jump into every stock that you like, but you have to manage a portfolio and manage the capital and everything else, and make sure that you're not setting yourself up for disaster by getting too overexposed in one direction. MENT though, 1742, I do like that as an entry play, which is where it's currently trading at. The volume looks okay. It looks like it's going to be higher today than what we've seen in the last week or two. So yeah, I like it. I definitely play it if you have the capital to play it with. Just make sure that there is no earnings reports coming out anytime in the near future. I've been having that issue. I've been finding a lot of good trade setups, but I can't take them because there's earnings that will come up in the next day or two. And I don't trade through earnings. Just don't do that. SIX. I think this one's already made the move. 64.88 would have been the ideal entry point on this one. It made it about 2 days ago, and it's off to the races. I'm not a huge fan of these kinds of breakout plays. I like to see some consolidation happen before the breakout. Sort of like with MENT here, right? You have a nice, consolidated range before it finally pushes higher. Now, when you go and do that with SIX, you don't see that same level of consolidation. Instead, you see a move from 61 up to 66, and that thing hasn't taken a breather yet. So I think at that point you're looking at the chunk of this stock's move on its current trajectory already have been made, and at this point you're getting in probably when a lot of people are selling their shares and booking profits to you. Let's go ahead and look at some of the stocks in the current portfolio then. WLL. This one's irritated me a little bit today because pretty decent sell-off. We have gotten a nice bounce with the market pushing higher here, but we're still down 1.4%. We were down much more than that earlier, almost well over 2%. But you see, you have a decent update yesterday following an upgrade, and then just today is just a nasty sell-off. But what it does reveal is that there is some support at this 10-day moving average, as we've seen in the past. So going forward, the idea may be to raise our stop loss to that 10-day moving average. I was thinking that I would probably cut this stock out of the portfolio. Things are looking a little bit better for me to keep this thing over the 3-day weekend, but it does still need to improve some. I want to see it get at least under 1% before I consider whether or not to keep it over the weekend. POL. POL doesn't bother me too much. I mean, it's down 1%. That's bothersome, but it's basically pulled back to the breakout level. So there's nothing worrisome about this stock yet. It's not a perfect breakout level, but you can see it's like that 23.16 level, 23.18 level, right where in that area of where we got in on the stock. So ideally what you want to see is this stock, now that it's pulled back, and you can see the volume was extremely light on the pullback, now that needs to bounce higher. And a lot of times this is where I get in on these stocks. I don't get in on the initial surge higher. I get in when it pulls back, and then I get in there. So had I not get into POL at this point, this might be a stock that I would be looking to get into now. All right, FCX. Now FCX is bothering me some today. I want to see this thing hold that trend line, and it's not doing that. We were in at 35.50, so this one might get axed today if this thing can't make a decent bounce into the close. We've seen it do it before, and it's a pretty volatile stock, but the setup isn't going in our favor. So this one might have to be, going to the woodshed afterwards to get chopped up. But anything can happen between now and the end of the day. We can see this thing rally hard and save it from having to get cut out of the portfolio. Adobe, we added this one yesterday. It really hasn't done nothing yet at this point. We got in at 38.88. It's trading at 38.55. So we're down about 0.8% on this one. The volume on the pullback really hasn't been anything to be concerned about. But yeah, we just want to see this thing get re-engaged and push higher. But I do like this chart still. Nothing that we've seen so far bothers me at all about it. EXP has been the star of the day, pushing to new highs at 2.5% up on the day. This one will likely see the stop loss get moved up by the time Tuesday rolls around. So no need to cover our positions on this one yet. Everything looks pretty solid on it, and we're going to continue to hold this one. So anyways, everything looks pretty good in the portfolio. FCX, a little bit troublesome there as it's breaking below that trend line. That's going to be probably a good reason for me to go ahead and book that trade as a loss by the end of the day, unless it makes a rapid recovery. WLL, I'm on the fence with. But there's probably a likelihood that we leave today a little bit lighter in the portfolio than what we came in at. All right, well, that's going to do it for today. If you guys have any questions, feel free to ask me at ryan@shareplanner.com, or if you're in the Splash Zone, just hit me up there as well. Y'all have a great 3-day weekend. I'll definitely be around, so if you have any emails, like I said, just shoot them my way. But I hope to see you back on Tuesday, and God bless you all.